Have you ever seen someone like this before? Well, you probably have, because this is John Hamm portraying the character Andrew Cooper from Apple TV series Your Friends and Neighbors. But have you ever seen somebody like this before? Meaning somebody rich, probably somebody very successful, maybe drives a nice car like an Aston Martin, or has something like a Rolex collection and a country club membership. And oftentimes you may find yourself wondering, man, I wonder what that person does for a living, or I wonder how that person came into the wealth that they have. And then oftentimes, and in many cases, it's true. These people are genuinely very wealthy. But there are many times when we don't tell ourselves or ask ourselves, maybe that person is putting on a front, maybe portraying somebody that they're trying to be, but really can't be. Oftentimes, people, like John Hamm's character, go into massive amounts of debt in order to fund a luxurious lifestyle and to portray themselves in an image of somebody who is really successful, but in reality probably isn't. And in many cases, the amount of debt that these people go into to impress friends, colleagues, family members, or whoever else end up regretting it as a result because that debt will eventually catch up with them over time. Well, in many cases, that same analogy can be applied to companies as well, or at least with companies that are very aggressive and very optimistic about what their future prospects are. And in many cases, these companies use debt to fund what that future image could look like. However, like the people who portray themselves as a wealthy individual, these companies get caught up in that debt, and the debt eventually catches up to them before the gravy train that they're on comes to a screeching halt. Well, in today's video, we're going to be analyzing a company that seems to be doing just exactly that. We're going to be taking a look at CoreWeave and how this company is using a very large amount of debt to fund its luxurious AI data center future, and if that future will come into fruition. So, let's take a look. CoreWeave as a company is actually a pretty simple business. This is a company that sells access to AI cloud and infrastructure services for its clients. More specifically, it essentially leases GPU clusters in something called high-performance computing clusters for AI model training and development purposes. It also sells infrastructure services, data and storage solutions, as well as management software called Mission Control. All business in this company is done under a single operating segment, and CoreWeave essentially makes its money by selling long-term committed contracts to its clients or essentially leasing these HPC clusters as an on-demand service. However, most of the company's revenue is earned through these long-term committed contracts. There are also some other key aspects of CoreWeave's business worth mentioning, specifically key operating metrics that are of particular concern to the company's management. This is RPO and power capacity. Power capacity is pretty self-explanatory, which is effectively the amount of electricity the company needs for its HPC clusters in order for its clients to develop the AI models it wants. Right now, CoreWeave currently operates 43 data centers throughout the United States and has a total power capacity of somewhere around 3.3 gigawatts, but the management has indicated that they plan on adding a lot more capacity in order to deliver more HPC clusters to future clients as well. The other key metric is something called RPO, which is remaining performance obligation. Remaining performance obligation is effectively remaining value on long-term contracts that CoreWeave has with its customers that hasn't yet been recognized as revenue. And the reason for this is because CoreWeave has to deliver on all of its performance obligations in order to get paid by its clients. So that means the company has to put all of the upfront expenses as well as associated overhead to deliver for its clients before it actually makes its money. The management has also indicated that some of the key metrics on the RPO or some key metrics that are tracked on these contracts can change over time. So RPO isn't necessarily unearned revenue. In addition to that, CoreWeave does rely on strong OEM relationships, specifically with NVIDIA, in order to deliver its HPC capacity to clients. It relies on NVIDIA's chips like HGX B200, the B300, the RTX Pro 6000 Blackwell Edition, as well as other chips like the L40 and the L40S, as well as others. CoreWeave's management also says that it does rely on some CPU clusters from suppliers like AMD and Intel, but these two businesses or these two suppliers aren't nearly as important as the relationship CoreWeave has with NVIDIA. Next, we need to take a look at CoreWeave's regulatory filings to get a better understanding of what the business's performance has been and how badly or how well they're currently making or losing money. And the first statement that we're going to look at is the company's income statement right here. The first thing to note about the company's income statement is that comparing the first quarter of 2025 to the first quarter of 2026, there was a 112% increase in the company's revenue. We went from $982 million in revenue last year to $2.1 billion, or almost $2.1 billion in 2026. The company has stated this is primarily attributable to the fact that there's a growing customer base and the amount of services that they're offering to existing customers is increasing. So this is an encouraging sign from a growth perspective, but we also need to look at what the company's expenses are. And what we can note is that expenses are increasing incommensurately with revenue. This is not a good sign necessarily. We saw the cost of revenue practically triple, going from $262 million in 2025 to over $700 million in 2026. This is a 173% increase, and this is because of increased rent and increased utility costs. As far as technology and infrastructure is concerned, this went up by 127% to over $1.2 billion in the first quarter of 2026. The company has stated that this technology and infrastructure expense also includes depreciation and amortization that they're paying on the large numbers of GPU clusters that they're now beginning to operate. In addition to that, we can also see that interest expense climbed quite significantly, more than doubled, in fact, from 25 to 26. We're now at $536 million in interest expense in 2026 compared to only $264 back in 2025. And this is because of the fact that the company is borrowing a lot more money than it did a year ago. And as a result, the total comprehensive loss for CoreWeave more than doubled through the first quarter of 2026 compared to the first quarter of 2025. We're now the net income is now at a $735 million loss for CoreWeave. So not necessarily good results. Another interesting thing that we can glean from this 10Q filing is what the company's revenue looks like and what its customer concentration looks like. And what's especially interesting is how CoreWeave reports this. They have significant customers that they identify as customer A, B, C, and D. So they're concealing the identity of who their main customers are, which is strange to say the least. But what's especially interesting is the concentration of these customers and how responsible they are for the company's revenue. A lot of people have reasonably surmised that customer A represents OpenAI, and if that is in fact the case, they're responsible for 45% of the company's revenue through Q1 2026. Customer B, a lot of people have guessed to be either Microsoft or Meta, which is another 20%. And then the ones that have asterisks represent could represent up to 10% of what the company's revenue is. This is an extreme concentration of customers, which is incredibly risky for the company's ability to grow because this does not represent very high quality revenue or very high quality earnings as a result. In addition to that, customers A, B, and C also represented the vast majority of what accounts receivable are on CoreWeave's books through Q1 2026. So this company is highly dependent on a select few group of customers, which is something that I think investors need to take note of. In addition to that, the amount of contract balances and remaining performance obligations the company has is also something they should take note of. This is effectively unearned or unearned revenue that could be recognized in the future at some point. They indicate they have $98.8 billion of unsatisfied remaining performance obligations, of which they expect to recognize 36% of that over the next 2 years until March 2028, and then about another 39% for the next 2 years after that, and then the remaining balance for the remaining years after that. So this could be delayed. This could be something that could change. CoreWeave may have to issue credits to its customers, but it still has a lot that it has to perform in order to earn all of that revenue over time. Next, we'll be taking a look at CoreWeave's balance sheet by comparing the assets from the first quarter of 2025 to the first quarter of 2026 in its filing. Now, the first thing that we can determine from this is that the company had an improvement of its assets from around $49.3 billion in 2025 to around $55.5 billion in 2026. This was mainly due to the fact that the company had a roughly $6 billion increase in property, plant, and equipment, as well as a roughly $2 billion increase in the operating lease right of use assets that it has on its balance sheet. This was mainly because of the large capital expenditure investments that CoreWeave made into its business over the course of 2025, as well as the first part of 2026. But these gains in the asset value of the company also went down a little bit, were offset a little bit by reductions in cash of roughly $1 billion and also a reduction in the company's accounts receivable from $3.1 to $2.1 billion. So there's a large increase in the amount of assets that CoreWeave have seen, and it looks like that's mainly due to fixed assets that the company is either acquiring or investing in. As far as liabilities and shareholders' equity is concerned for CoreWeave on its balance sheet, we also saw some pretty similar moves with respect to the amount of debt that the company took on. One of the interesting things to note as well is that there was an increase in the amount of accounts payable that more than doubled from $1.6 to $3.3 billion from 2025 to 2026, but accrued liabilities went down quite significantly as well. Another interesting thing to note is that current debt for the company grew from $6.7 to roughly $7.5 billion, and non-current debt went up from roughly $14.6 billion to $17.3 billion, which is quite a big increase. This brings the total amount of debt that CoreWeave has on its books to roughly $24.9 billion. Plus, we also have to include the fact that the company has some lease liabilities of roughly $15 billion on its balance sheet as well. So while we did see a significant increase in the amount of assets that the company has, we saw a roughly commensurate increase in the amount of liabilities that the company had that mainly came in the form of increased AP as well as increased debt. As far as equity is concerned, we saw additional paid-in capital move from about $3.3 billion to roughly $4.7 billion from 2025 to 2026. The accumulated deficit that the company was carrying on its books also grew a little bit from $2.6 billion to roughly $3.3 billion. So while the company is definitely making a lot of very aggressive investments in itself for its AI infrastructure and expanding its business, it's fueling this mainly with debt as opposed to issuing equity. And there's also some signs that the company is using some of its cash to take some of its accrued liabilities away, as well as its aging accrued liabilities away, I should say, as well as allowing current accounts payable to continue to grow so that the way the company can make the most efficient use of its cash. And speaking of cash, we can then take a look at what CoreWeave's statement of cash flows look like when we compare the first quarter of 2025 to the first quarter of 2026. Now, the first thing that we can note is that there was a significant improvement in depreciation and amortization. We went from $443 million in non-cash expenses of D&A to over $1.1 billion in 2026. In addition to that, there was also a very large delta in the changes in working capital as well, namely with accounts receivable as well as with things like accounts payable and accrued expenses. AR went up by more than $1 billion, which means that the company's operating cash flow improved with all those factors accounted for from $61 million at the end of Q1 2025 to over $2.9 billion of operating cash flow in 2026. Additionally, we can also see that the company did some other things like the increases in deferred revenue as well as increases in accounts payable as well. So while there was favorable turnover changes in working capital, we also saw very large changes in things like depreciation and amortization. As far as investing activities are concerned, the company had a lot of outflows for the purchases of property, plant, and equipment of about $7.7 billion. This is a very large outflow, which essentially means CoreWeave is a free cash flow negative company because our CapEx expenses vastly exceed what our net cash provided by operating activities are. There weren't anything other material changes with respect to investing activities. It was mainly just the CapEx expenses. With respect to financing activities, we saw a $3.3 billion inflow from the issuance of debt, which is quite a significant change of only $785 million of debt being issued in Q1 of 2025. So CoreWeave is definitely being more aggressive about raising debt in order to fund these CapEx expenses. And we also saw some changes, some outflows from financing for the repayment of debt that was more aggressive than it was a year ago. But it's not nearly to the same degree at which CoreWeave is raising debt from its financing activities. Overall, we did see cash and equivalents at the beginning of Q1 2026 go down from about $4.1 billion to about $3.3 billion in Q1 2026, whereas a year ago there was actually a positive change in the company's cash position. With respect to all this, CoreWeave is definitely being very aggressive with its operating, investing, and financing activities, namely with the amount of debt that it's raising and namely with the amount of CapEx that it's spending. So now that we have a good understanding of CoreWeave as a business and we understand how it makes its money, as well as what its recent financial results have been, we can then do a SWOT analysis on the company to assess what its strengths, its weaknesses, opportunities, and threats are. First, we'll start with strengths, and the most obvious one has to be the company's growth. It's experienced absolutely fantastic, even explosive growth, especially over the last 2 years. Year over year, on a quarterly basis, the company had 112% revenue growth and has a $99.4 billion RPO backlog. Definitely a strong basis of support, especially for growth moving forward. Another strength that CoreWeave has is its strategic partnerships, specifically with hyperscalers and large companies like NVIDIA. It recently received a $2 billion private placement investment from NVIDIA and has commitment from large companies like Microsoft, OpenAI, and Meta to provide the HPC capacity that these companies need, giving CoreWeave a very strong backing for being an especially young company. Some weaknesses are definitely glaring, especially the capex and debt spiral that CoreWeave seems to be getting itself into. As of the first quarter 2026, there's $25 billion of debt on the company's balance sheets, and that results in $536 million in interest payments in the first quarter of 2026 alone. This puts a massive pressure on the company's ability to turn a profit as well as cash flow. Additionally, there's some guidance that indicates the company could have an additional $35 billion in capex expenses through the end of 2026. So this means that CoreWeave has to raise that money somehow, and likely means it's going to add even more leverage for its balance sheet in order to achieve that capex growth that it desires. Another weakness is growing losses. There's a growing loss in operating and net margins. A loss from $315 million last year in the first quarter of 2025 to a $740 million loss to the first quarter of 2026 is not a good sign. Net losses more than doubled and operating losses quintupled from the first quarter of 2025 to the first quarter of 2026. So while the company is growing quickly, its losses are growing quicker. As far as opportunities are concerned for CoreWeave, it has a growing customer base. The management has indicated that most revenue growth through the first quarter of 2026 came from new customers. Companies like Jane Street, Meta, Klein, and Perplexity have all gone to CoreWeave to get additional HPC capacity, thus improving the company's earning quality and an opportunity it can certainly take advantage of in the future. Another one is structural demand. There's 43 data centers that the company has operating in the US right now, and it aims to have an additional 1.7 gigawatts of operational capacity by the end of 2026. There's also some aggregate estimates about data center development overall that total demand will be somewhere around 49 gigawatts by 2030. This means that CoreWeave is essentially ahead of the demand curve and trying to get ahead of the curve so it can supply that HPC capacity to potential future clients. As far as threats are concerned, interest rates definitely has to be a big threat for CoreWeave. CoreWeave's biggest credit facilities are all variable rate debt, which totals to about 11 of the $25 billion of debt the company has. This exposes the company to macro factors like treasury rates, SOFR, as well as other interest rate variables that could potentially have an impact on the debt and subsequent interest payments that they would be responsible for. If CoreWeave cannot refinance that debt at rates equal to today or even lower, it could spell some very big problems for the company's ability to service that debt and the cash flow that it can generate. Another threat that CoreWeave has is its own customers. Its customers are becoming self-sufficient by hyperscaling and building out their own data center capacity, specifically Meta and Microsoft. So, if Meta and Microsoft build enough capacity on their own such that it satisfies their needs, then their need for having CoreWeave essentially goes away, and this is a massive threat to the company's future earnings. Next, we need to gather some financial metrics and information on CoreWeave's stock in order to support our discounted cash flow model so that way we can assess what the company's implied share price should be. And as of market open on June 25th, 2026, the company is currently trading at about $100.49 per share. But in addition to that, we're also going to need some key stock quote data on the company. So over here, we can see things like the average volume, which is about 30.22 million shares over the last 65 days exchanged between buyers and sellers. The company has a market value, or also known as market cap, of about $55 billion. There's around 447.5 million shares outstanding available for trading, and the company is currently losing $3.15 per share. So there's no price to earnings ratio, and the company also does not issue a dividend at the moment. We're also going to need something called the beta, which is a measure of the share price volatility. And for CoreWeave, that's at 2.57. So what that tells us is that CoreWeave stock is actually much more volatile relative to the stock market. In addition, we can also get the idea of what the company's short interest is, and it looks like there's about 54.6 million shares being shorted at the moment. This is about 16.14% of the company's public float. So typically, a short interest is much lower than that, so there's a significant number of short sellers in CoreWeave at the moment. So now that we've just gathered some information on the company's financial metrics, we can then conduct our discounted cash flow analysis and determine what the fair price for CoreWeave stock should actually be. And the first thing that we need to do is make some base assumptions and input the data we collected into the model. So the first assumption that we're going to make is having a 2% terminal growth rate for CoreWeave. Here, we put the company's current share price, as well as the shares outstanding, the beta, and the dividends per share. In addition to all that, we're going to need what the current yield is on the 10-year U.S. Treasury bond, which is at about 4.4%, to help us get an idea of what our risk-free rate of return is. And then we're also going to assume that an investor in CoreWeave will expect about a 9.5% rate of return on their investment. And then finally, after looking at all the debt tranches on CoreWeave's books, we can surmise that the company's weighted average interest rate on its debt is about 9.06%. With all of that in mind, we can then calculate what the weighted average cost of capital is for CoreWeave. So, as of its latest regulatory filing, its 10Q as of March 31st, 2026, the company has about $24.8 billion of debt, about $4.7 billion of shareholders' equity, and about $2.2 billion of cash. So this means that CoreWeave is weighted 16% towards equity, about 84% towards debt, which means that the company's weighted average cost of capital is about 9.12%. Next, we then have to look at CoreWeave's free cash flow over time, as well as forecast what CoreWeave's free cash flow is going to be in the future, and then use valuation methods to determine what we think CoreWeave stock is actually worth. So this data in blue right here indicates what CoreWeave's historical free cash flow has actually been in the past, and then the data in black below it indicates what we're forecasting the company's future free cash flow to be. Now, the way I came up with forecasting the company's free cash flow is based upon what the company's revenue growth rates look like, its expense growth rates look like, as well as what management's guidance is for future CapEx. So I do think that 2026 will actually be even worse for CapEx than it was in 2025. In 2027, the company is probably going to spend a lot more money as well building out additional data center capacity. I don't think we'll probably see CoreWeave be free cash flow positive until 2029, and that's based upon a lot of the CapEx expense, as well as how it depreciates a lot of the GPU clusters it utilizes for training AI models. In addition to that, the company also does have growing expenses as well, so I think that it's going to take some time for them to take advantage of economies of scale. So in 2032, I'm forecasting about $5.2 billion in free cash flow. However, we have to discount all of that future free cash flow back to today's present value, which is what's going on right here. So while I'm suggesting that the company will have about 5.3 billion of free cash flow by the end of 2031, that's only worth about 3.1 billion in free cash flow in 2026 dollars. Next, we can then take a look at what the terminal valuation, the enterprise valuation, and the implied equity value is for the company. The terminal valuation for CoreWeave is effectively the maximum potential value the company we think can be in perpetuity and beyond our forecasted period, so into 2033 and beyond. This is based on some of the investment assumptions that we've made in the model, and this is at about $44.6 billion. Next, we can look at the two enterprise valuation methods. One of them is the free cash flow method, and the other is the equity method. For free cash flow, this is effectively that terminal valuation plus all of the free cash flow that we looked at for the company over time. And then the equity value is the sum of the company's debt and equity financing less the cash it has on its books. Now, for the case of this model, I'm relying on the equity method for enterprise valuation just to be a little bit more kinder to the stock. So effectively, the implied equity value for CoreWeave is essentially its net asset value of around $4.7 billion. So while the company's currently trading at around $100.50 per share, the implied share price based upon this model and its assumptions is only about $10.63 per share. So let's say that you decided to buy 1,000 shares of CoreWeave stock on June 25th, 2026, and you were going to sell all those shares at the end of 2032. If CoreWeave's valuation was purely based upon what the company's discounted future free cash flow is, and also assuming that you will not earn a dividend at all today or in the future on CoreWeave stock, you would lose around 29% on your investment. So this does not look good at all. Next, we're going to be doing some technical analysis on CoreWeave to see where the stock price is actually going to go in the near future. Now, right here, we have CoreWeave on TradingView with its stock going back to the beginning of 2026. We have a 100-day simple moving average with Bollinger Bands, and the other technical indicator I'm using is an MACD down at the bottom with a bullish or bearish signal. Right now, CoreWeave at about $100 per share is trading below its 100-day simple moving average, but the company's stock is quite volatile, and its stock price actually does pretty frequently break out of its Bollinger Bands, especially here, 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 and back here. So as well as right here and here. So there are actually a lot of instances in which CoreWeave does break out of moving averages quite frequently. The stock also does experience some pretty big volume spikes roughly every 3 weeks, and I think that that pattern will likely continue based upon what the company's earnings look like, as well as different movements and news, because the stock does react pretty strongly to given news. As far as what our MACD indicates to us, the signal and leading line are roughly converging at the moment, so we may see some bullish activity out of CoreWeave, and the company's stock price might recover to somewhere around $115 per share, especially within the next couple of weeks or months. But overall, the fundamentals of this business definitely indicate a bearish signal for me. I think that CoreWeave is way too expensive where it is, and overall, we may see some upturn in the company's stock price in the near future. I think long-term, I definitely see a downtrend. So is CoreWeave a buy, a sell, or a hold? In my opinion, I think this is a company that's actually massively overvalued at the moment, and I think that this is a business that probably isn't worth what its stock price suggests. This is a company that has experienced very impressive and very explosive revenue growth, especially in the last couple of years. It has good relationships with AI hyperscalers and a slowly growing customer base that is a sign of improvement. But the simple fact of the matter is that its expenses are vastly outgrowing its revenue sources. And something that's of especially concern with CoreWeave is its debt load and its CapEx commitments. This is a company that's trying to grow at a rate that's simply not sustainable. And while they certainly are trying to capture economies of scale at some point in the future, things are probably going to get worse with respect to free cash flow before they get better. And it may take a very long time, in fact, maybe even too long of a time for the company to capture economies of scale before things actually turn free cash flow positive for CoreWeave. So at the moment, my target price for this company is $18 a share. I think our discounted cash flow model was a little bit too pessimistic with simply CoreWeave being worth its net asset value, because there is some valuable software IP in there, but this is a company that doesn't appear to be as valuable as many people suggest or believe it to be worth. However, I'm also curious to know what you guys think. So let me know what you think of the video. Give me your thoughts on the data. Give me your thoughts on the analysis, the summary, everything. I'd love to hear your thoughts, so please feel free and weigh in the comments, especially if you disagree. I'm really interested in hearing from those folks too. And if you guys have a request for a different publicly traded company, make sure you let me know down in the comments, and we can do the analysis together. As always, thanks for watching.